Just to give everybody some information regarding the LaunchBox. This event is sponsored by the Penn State Mont Alto LaunchBox. We're one of 21 innovation hubs around the Commonwealth of Pennsylvania. Our mission is to support and promote innovation and entrepreneurship for small businesses in our regions, for the growth of small businesses. The Mont Alto LaunchBox offers workshops, such as today's event, on various topics that are relevant for startups and for small business. Those topics include business planning, legal matters, access to finance, and even operational day-to-day subject matter, like our February 1st Lunch and Learn, which will be on the topic of maintaining productivity. So we hope to see you back for that one. Other services and resources that are available to small business through LaunchBox include business and IP law, assistance with incorporation, and even business coaching. And all of these resources are free of charge to entrepreneurs in the region. We partner with the Small Business Development Center, we partner with economic development officials, and have access to Penn State's comprehensive resources available throughout the Invent Penn State system. LaunchBox is also running an idea test lab in February. So if you or you know of someone who thinks they have a good idea for a business, they should definitely apply to be part of this process. It's throughout the month of February. It culminates the beginning of March. It's a rigorous customer discovery process. You'll have an opportunity to work one-on-one with a coach and be able to vet your business idea and see if it really has legs. One other annual event that I wanted to mention through the Mont Alto LaunchBox is Lion Tank. Lion Tank happens once a year in spring. It'll be in early April next year. And this is a Shark Tank-like pitch competition that is open to folks from our community. So Penn State students and the local community can apply to be involved in that. And all of that information is available on our website. So that's it in terms of introducing LaunchBox. Now I'd like to get to the main event and introduce you to Bev Steitley. Bev is owner of Saunders Tax and Accounting. She has over 30 years of experience in the industry and is an enrolled agent with the IRS, a profit first professional, and a certified Fix This Next advisor. And Bev's focus and passion is helping small business owners find success in their business. So I'm going to hand it over to Bev.
Thank you very much, Helen. I appreciate that. Leighton, I appreciate what you guys are doing, starting out with the Cumberland Valley Alliance and the LaunchBox. I mean, so many wonderful local resources for business owners. They should be taking advantage of those things. So I hope you all are that are here with us. Okay, so we're going to talk about taxes, such a boring topic, and I apologize for that, but that's what it is. I am actually also, one of my titles is tax nerd, because I find these things interesting on how to use the existing tax code that there is and use it to your best advantage. So understanding what is out there, what is available, your best advantage. I don't see why anybody ever needs to cheat on their taxes, because there's just so many different things in the tax code that you can be using to help yourself, and especially if you are a business owner. So we're going to talk about business taxes. And let's first off talk about the different types of business taxes they are, because that depends on what your entity structure is, what your legal structure is, what type of a tax return you will file. Now, I will tell you, I have listed here C corporation, an S corporation, a partnership, a sole proprietor. As we get into talking about specific expenses and deductions, they are available to every type of business. So your little Schedule C, sole proprietor business, where you're doing some type of online sales, follows the exact same rules as AT&T or Procter and Gamble. They are all the same rules. There's just more zeros behind their numbers than there are behind yours. That's the only difference in it. But the rules run the same way for the most part. But part of it is legal structure. And so we do want to talk about that first. So a C corporation or a regular corporation, corporations and LLCs are set up under state law, but for tax purposes, C corporation, a regular corporation, meaning it has not made any special election, files an 1120 tax return form, shows all their income, all their expenses, a section for their balance sheet, and whatever their bottom line profit or loss is. If there's a profit, they pay tax on that profit at the corporate level, which currently right now is a flat 21% tax bracket. So whatever your profit is, 21% for your federal taxes, and then whatever states you do business in, you'll file a business return for them. So I'm going to assume that none of you guys are that regular corporation, that C Corp, because usually they are not at these types of events. But you may be an S corporation. So an S corporation has filed a special election with IRS to be treated as the subchapter S corporation. And it kind of gives the benefit of both worlds. So it files an 1120 S tax return, shows all of the income and expenses on that corporate tax return. Within that bottom line, whether it's a profit or a loss, they pass that bottom line amount over to the shareholders. Now, one of the rules for an S corporation company is they can't have more than 100 shareholders. Normally, most S corporation companies have 2 or 3 shareholders. It's a family group or just a partnership with someone. So you pass that over onto your personal return and you take that loss against your other income, or you claim that profit with your other income, and you're taxed at wherever you are on your individual rates. And so that usually gives us a better tax outcome for the business. And at the corporate level, you as the owner can be on payroll. So you would also be an employee of the company getting a W-2 for payroll. The next type of entity is a partnership. So 2 or more people going into business together, whether they set it up as a legal structure or is just a more common law structure together. Sorry, I have a hair on my lip here bother me. There we go. Partnership, it's going to do the same type of a tax return. It does a 1065 form. It does the income and expenses for the partnership, the balance sheet information, and then that bottom line profit or loss for the partnership gets passed through to the partners based on what percentage of ownership they have, and they include it on their personal returns. Now, the partnership, the partners are never on W-2, and so whatever profit is coming over for that business is going to be subject to Social Security and Medicare tax on your personal return, self-employment tax. So you'll notice the due date for the S corporation and the partnership are both March 15th. They're due a month earlier because they're creating a document called a K-1 form to go onto the owner's personal 1040 tax return. So they have to get their returns in earlier than the April 15th deadline. The majority of you are probably sole proprietors. You're just starting off in business or have a small business that you are looking to grow. Simplest form of operation of a business. I like keeping it simple as I deal with business clients, because as you keep it simple, you don't need to add complication. You don't want to become a partnership, an S Corp or a C Corp until there's a valid reason to do that. Don't create large structures that you have to try to maintain. You want to keep it simple. So sole proprietorship is a very simple business structure to start. As far as the federal level goes, there's nothing you have to do to create a sole proprietorship. You just start in business. Now, at your state level, you may have some other things that you need to do depending on the type of the business. If you're selling something that you need sales tax, you need to register and get a sales tax account number. If you are going to be doing something maybe in construction where you need to have a contractor's license or electrician's license, you'll need to have those types of things, which are done at your state level. But as far as federal is concerned, $1 of income, you're in business, there you go, you are a sole proprietor. So that business files a form called a Schedule C form as part of the 1040 tax return, showing its income and expenses on that Schedule C form, bottom line profit or loss, merges in with all the other income, W-2, interest, retirement, whatever you may have on your tax return. Notice none of the entity structures for taxes, nowhere did I list an LLC. And I know a lot of people get confused with this. And I just had a new person call for a discovery appointment yesterday. And as she was talking, that she decided to set up an LLC for the tax advantages. And I had to tell her there are no tax advantages for an LLC. So an LLC is a disregarded entity to IRS. There is no form to file your taxes for an LLC. IRS simply says if you are a single member LLC, so one owner to the LLC, you file as a sole proprietorship by default. You're a sole proprietorship, that's your category. If you're a multi-member LLC, so more than one owner to the LLC, for tax purposes, you are a partnership. Even if that other owner is your spouse that'll be filing that same joint return, you are a partnership and would have to file a 1065 partnership return first, and then pass through that income onto your personal return. So that's where LLC stands. Understand that. An LLC gives you some liability protection, and you'd want to talk with a lawyer about the liability protection, whether it is valuable to you or not. To have that additional protection, does it make sense in your business? But it is not a tax structure for you, so it doesn't give you any help with your taxes. So just wanted to point those things out. So one of the biggest problems for business owners, especially ones that are starting out with a smaller business, is their record keeping. So first off, you need to have a separate bank account for your business. Do not commingle the money between your business and your personal at all. If you need to loan money to the business or contribute money to the business to help it get started out, that's fine, you do that, but you don't from the same bank account pay personal expenses and business expenses. Do a separate bank account for the business, a separate credit card for the business, because you're going to need to use credit cards for some of those. And here, if someone texted me trying to get on the luncheon. So separate credit card for the business. So if you are, if that card does not need to be in the business name, it can be a personal card that is in your name, but you only use it for business expenses. It will make your life so much easier as you're trying to do your bookkeeping and keep records of your expenses, to have that credit card that is only business expenses, bank account only business expenses. No personal expenses out of the company account. Now, since you're going to pay tax on that bottom line profit of the company, you are more than welcome to pull a draw of the profits out of the company, that's your pay, and put it into your personal account and then pay your expenses. But don't be paying personal expenses out of the business account. Decide on a system of keeping track of your expenses. Okay, so you can do a software like QuickBooks or QuickBooks Online. QuickBooks is the big guy in the market. The 300-pound gorilla. They have an online version, a desktop version. They are both lovely. They are both totally different. So you'll want to test both of them out to see which one will work better for you. If you're not really a software person that wants to learn that accounting system, you need some way to track what you have going on, okay? So it can be a basic Excel sheet if you still like using something that's on a computer. We actually have on our website, saunderstax.com, under the downloads from client resources, we have an Excel spreadsheet that is set up for sole proprietors that you can use to track your expenses. If you're the old pencil and paper person and you want to use those green ledger sheets, more than welcome to do that. Anything that is simple for you to do to keep track of where you're at, you will want to use that, because you need to, not only for your taxes to know these bottom line totals, but if you're going to manage your business well, you need to have good financial information. You need to know where you're at in your business, how profitable it is, how profitable each product line is that you have. So that is a whole nother topic. We won't get into that. But for taxes, I need totals, total income, total for advertising, total for insurance, total for, et cetera, whatever it is. So where we are at, we are very close to state lines here, and we cross the state line frequently for a lot of things personally. You may also end up crossing the state line for your business. Remember to be tracking your income by what state you're in when you generate it, okay? Because you've created nexus in that state. So if you're in Pennsylvania and you cross over the Maryland line here to do business, you're going to have to file a Maryland non-resident return for your business. And so you need to track how much income comes from crossing the state line. As you cross the state line, if you need to be doing sales tax, if whatever you do is taxable here in Maryland, and you need to pay attention to your jurisdiction, what tax rules there are. For example, sales tax here in the state of Maryland, if you do cleaning services. If you do residential cleaning services, you do not charge sales tax in Maryland. But if you do commercial cleaning services, you have to charge sales tax in the state of Maryland. So if you cross the state line, make sure you understand what your requirements are on that state, in that state too. So make sure you're tracking your income by the state. And then remember, you're taxed on your bottom line profit, not on the top line that you bring in. So I'm frequently asked questions about that top line number. I made this much, I took in this much in my business last year, $50,000. How much am I going to have to pay in taxes? Well, I don't know. It depends on what your expenses are, because you're taxed on your bottom line profit. So income minus expenses gives us our profit, and that's what we pay taxes on. So let's talk about the expenses and what you should be tracking and how you should be tracking. First off, you want to track all the expenses. IRS does not have a list of expenses that you can deduct. They tell you whatever is ordinary and necessary to perform the duties of your business, to run your business. Just ordinary and necessary. And in one type of business, what's ordinary and necessary might not be the same thing in another type of business. So what do you need to run your business? And so most of you would be very quick to understand that your advertising is an expense, and the business insurance is an expense, and the office supplies you buy are an expense. We're going to talk about some of the ones that are a little bit of that gray line and how do I track this today and what we're doing. So first off, startup expenses. So you are not in business until you are ready to open your doors and make that first sale. But you're doing a lot of work to get yourself prepared for that in business. All right, so those are called startup expenses. So you may right now be doing some training classes, doing some market evaluations, investigating some softwares for your business, et cetera, whatever it is. But if you're not ready to service your first customer yet, you're not in business yet. So all those expenses that you spent here in 2021, and you are not ready to make your first sale until January of 2022, you're not in business yet. You're not in business until January when you open your door. So if you think of a brick and mortar store, we talk about opening the door. So when we can open the door and sell the first product, and that's different based on what kind of service you're doing and if you're doing it online. But when you're ready to service that first customer, that's when you're actually in business. So for a lot of my clients, I talk about when you make that first dollar of revenue. When are you ready to make that first dollar of revenue? So those expenses are not ignored, but you can't file Schedule C with just those expenses and no income. Okay, those are called startup expenses. You hold on to that information, that dollar amount that you spent. And when you open your doors, when you're ready for business on that year's tax return, you're going to take a deduction for startup expenses. And IRS allows you to take an expense up to $5,000 right on that first return. And any expenses you have over $5,000, you're going to amortize those out over 15 years and take part of that on each year's tax return. Okay, so that's our startup expenses. Meals is often one that I see as a expense that people aren't quite understanding. There's been a couple of rule changes recently. 2007, we had a lot of rule changes, and here for 2021, more rule changes. So first off, a legitimate business expense meal is one of two things. One is I've traveled away from home long enough that I require sleep. So I've gone away for a conference or a seminar, et cetera, something like that. If that is a business trip, then my meals during that trip are business meals and are deductible for me on the tax return. When I am local at my tax home where I work, as I am traveling out during the day, if I just stop to get lunch, that is not a business meal. That's just my own personal meal. That was my choice. Now, if I go to lunch with a client, a prospect, a vendor, a business associate, something like that, then that is a business meal. If there is a purpose to the meal that is business related, then we are a business meal. Up until this year, these were only ever deductible at 50% of what you spend on the meal. But one of the CARES Act changes is that for 2021 and 2022, if the meal is purchased at a restaurant, it is 100% deductible. Okay, so meals purchased at a restaurant, 100% deductible for 2 years. Okay, so just understanding the meals. So the records that IRS requires you to keep for a business meal is the date, the cost, who you were meeting with, and what business was discussed. So I would always take that receipt from a restaurant, turn it over on the back, jot down on who I talked to and what we talked about, just a real brief description. That is the backup information required to claim business meals. Okay. All right. Next topic, home office. So I frequently hear people that start off in business that they don't want to do a deduction for their home office because they've heard something. They've heard that it increases the chances of being audited for your tax return, or it's going to give you problems when you sell your house because you have to reclaim the depreciation. I'm going to tell you, neither one of those things are a barrier to that. First off, it hasn't been since the 70s and they changed the rules about home offices that was something that kicked an audit. It no longer does. That had been a long time ago. And when you sell your home, you're going to have to treat it the same way, whether you took the deduction for it or not. So your home office has to be the principal place of business exclusively and regularly for administrative or management activities of your trade or business. And you have no other fixed location where you conduct substantial administrative or management activities of your trade or business. That's IRS's definition from their publication 587. So your office and home just has to be a dedicated area. It doesn't need to be an entire room that is used regularly and exclusively for business. So in my little picture that I have here, you have this little desk area in the family room. This is your office right here, that square footage of that desk and chair. It is not the entire room, okay? And you can take the deduction for that. And so this is how you would calculate it. You look at the total of your house. You can do this on a by room basis. So for example, if you have 10 rooms in the house and you use the entire room for one room as your office at home, you can take 10% of all your expenses. Or you do it by square footage. And so many of us now that we have these open concept home floor plans, it's hard to say a definite room for the living room, the dining room, etc. But you look at what is your office space, and then you look at the total square footage of the house, the total square footage of the office space, subtract out any common area from that, and then you get your percentage then of how much you can deduct of that home. And you can take that percentage of all your expenses for the home. So your mortgage interest, your real estate taxes, it's a better deduction for you on your business than it is on your Schedule A. Most of us can't itemize anymore because of the rule changes. I can take that percentage of my utilities, my security, my cleaning. I can take all of my office furniture and decor, and I can depreciate the house over 39 years and take that percentage of it. Okay.
Bev, we have a question. Can I interject with that quickly?
Yes, please do. Yes.
So this question is, if you use your computer for other things, can you still get the deduction?
So not the computer in the home office. So in the home office, if anybody sits there to do other things, you have blown the rule for exclusive use of that area. So that area you have for your office, only thing that gets done there is business work. So there is no paying your personal bills there. There's no kids getting on the computer there, none of that. Okay. Now, if you have a computer that is a laptop that you can move, would be your better idea if you're going to use it for multiple uses. And so, yes, if I have this laptop computer that I use for my business and I use for personal use too, I can take a percentage of the computer. I actually do need to get a percentage of time. Of the time I'm on the computer, 30% is for business, 70% is personal, or 50-50, or whatever it may be in how you use your computer. But you can take that percentage of your computer, but home office has to be pure. It has to be 100% for the home office.
So that's good clarification. A follow-up is, if you don't take the home office deduction, are there deductions you can take, like percentage of utilities?
There is not. The only way you can do the percentage of utilities is by doing a home office deduction.
Okay.
Yeah, there are not other ways of doing that. And actually, a few years ago, 2015, IRS came up with the safe harbor method. So sometimes people found this getting their utilities, total it all up, and the mortgage interest and depreciating the home to be a little bit more than they wanted to do in paperwork. So IRS came up with a safe harbor method. They actually do $5 per square foot up to a maximum of 300 square feet, which would be a $1,500 deduction. So you can do an office and home if you have an exclusive, again, you still need to have that exclusive area, which you can do a $5 per square foot instead of totaling up all the deductions. You do whichever one is better for you. So IRS allows you to do this. One year do one method, the next year do the other method. You can switch back and forth between these two methods. Sometimes they don't allow that for other types of things like mileage. We'll talk about that in a minute. But you can switch back and forth from this. So then you're never really depreciating the house if you use the safe harbor method. But whichever year gives you a bigger deduction. So if we have a year that we had a lot of repairs and maintenance on the home, it may be a bigger deduction to do a percentage of the home. But then the next year it may be better to do the safe harbor. So you can bounce back and forth between those two. When you sell, you have to recapture any depreciation that you have used. Okay. And yes, I see the question. You can depreciate every other year. That is true, because depending on which method you use. But IRS actually says when you sell the home or when you sell any asset, you have to recapture depreciation allowed or allowable. So if you were allowed to take depreciation and you just chose not to do the home office, you're still required to recapture the depreciation on your tax return when you sell the home. So you might as well take the deduction while you have it. And truly the biggest reason that I find that home office a benefit for my tax clients is because it increases the number of miles that I can claim as business miles. If I do not have an office and home, going from my house to the first stop of the day, whether it's visiting a client, going to pick up supplies, whatever that may be, that is commute and is not business miles and is not deductible. And from the last stop of the day home, it is not deductible. That is just commute. It would be the travel in between my stops that were deductible if I do not have an office and home. If I have an office and home, I am now at my fixed business location, and I have left my fixed business location to go see my first client of the day, and that now is business miles. So I can get a small deduction for the home office deduction. Usually $1,200 to $1,800 is the deduction I normally see for an office and home. But the way it increases the number of business miles I can take from my business is very dramatic. And that's where I see the increase, is being able to claim more business miles by having that office and home. So again, doesn't need to be a big room, can be just that desk in the corner of a family room, something like that. But you only are counting that area where the desk is at. You're not counting the entire family room. Okay, so that is your office and home. So that small footprint is going to save you a lot of money on your taxes. Remember, anytime we can increase the expenses, decrease the profit on that Schedule C sole proprietor, I am decreasing what I pay in income tax, and I'm decreasing what I pay in Social Security and Medicare, the self-employment tax. So I'm actually decreasing two taxes with any business expense I can do. So maximizing those the best you can. Car and truck expenses. Sometimes we do this the wrong way. Now, this is a survey from 2019 from AAA for different size vehicles and how much it actually costs to maintain them. Okay. Now, for 2020, our mileage rate was 57.5 cents a mile. For 2021, 56 cents a mile. Don't know what the 22 is yet. I know they've announced it, but I just don't remember what it is. So we'll look at the size vehicle, look at the vehicle that you drive. Where does it fall in the maintenance category? So for example, I have a small SUV, four-wheel drive. I get very good gas mileage on it, very few repairs on it. If I was using it in business, I would just take the standard mileage rate on it, because the standard mileage rate really is more than what it costs me to maintain that vehicle. My husband has a Ford pickup truck, one of those that gets 12 miles to the gallon. You know what I'm talking about? Yes, if he was using his truck in the business, I would make him do actual expenses. So we would keep track of all the gas that he spent, all the oil changes, the repairs, the car insurance, everything on the vehicle. So on your taxes for business use, you get a choice of the two. Now, both methods, you have to track your mileage, and they'll ask for the total miles on the vehicle for the year. And of those total miles, how much is for business? Okay, so when you're doing the standard mileage rate for 2021, we would simply take those business miles times 56 cents a mile, and that would be my deduction for the use of the vehicle. And that is everything for the vehicle. So you're not deducting anything else for the vehicle. No gas, no insurance, no depreciation, no repairs, nothing for the vehicle. It's all built into that standard mileage rate. The only thing that would be additional is whether you had any tolls or parking when you were traveling with the vehicle. But if you're doing actual expenses, you still have to track the mileage. And so we look at the total miles on the vehicle for the year and the total business miles on the vehicle, and that gives us a percentage, just like the office and home did. So with that percentage, do I have, 20% of the time it's used for business, or 80% of the time it's used for business, whatever that business percentage is, then I would take that percent of the gas, the repairs, the maintenance of it, the insurance. I would depreciate that percentage of the cost of the vehicle, and that would be my deduction for the use of the vehicle. Okay, so you're going to use one of those two methods for it. Leighton, I see that we have a couple questions in chat about the truck, so let me back up here and get those. If you have a truck and take truck expenses, do you have to get a commercial plate and depreciate it? What about a loan on the truck? No, you do not need to get a commercial plate. There is no requirement for that. You only have to worry about that if you're subject to Department of Transportation rules because of the size of the vehicle and the loads that you're carrying. The loan, it would never be the loan payment amount. It's the interest on the loan that would be your deduction. You would get to take a percentage of that. But the principal of the loan, that's the cost of the vehicle, and that's what's actually getting depreciated on there. And then the second question from Joe, if I work for a company where I went to an office, but last year was working from home, can I apply the same mileage principles if my office was in my home? And can I deduct my home office in this last year? So Joe, you start this off saying you work for a company. And so on the federal return, there is no deduction for you because W-2 employees don't get to take employee business expenses. They went away in 2018. On your Pennsylvania return, you still can take employee business expenses, so you'll be able to do it on your Pennsylvania return. They will ask for a letter from your employer saying that you are working at home as a convenience for your employer. So if it's a choice of whether you're working from home or working at the employers and you choose to work at home, Pennsylvania will not take that deduction for the office and home, but it's for the convenience of the employer. If they've asked you to work from home, they will do that for a W-2 employee. If you mean you're a subcontractor for a company, then yes, you're okay, because you're going to do a Schedule C sole proprietorship and the same Schedule C sole proprietorship. So you can work from home if you want on a Schedule C, or you can work at a job location. So the choice is okay, and that is okay on a Schedule C expense, both on the federal and on the Pennsylvania.
Well, a lot of people worked from home last year, and they converted space just like you described, whether it's a kitchen or a dining, whatever, they converted it into an office. And so there's probably a lot of people in that position. I wasn't asking it for me. I have
Right.
another business. I deduct but I was trying to extrapolate on what you said about how you look at what the opportunity for taxes would be. And so the home office was one, but the other one that I was trying to get to is when you are working at home as a convenience for your employer, if you do travel, can you do that travel from your home office, or do you still need to do the travel less wherever your office distance would have been?
You can do it from your home office. Yeah, so that would be okay. But again, when you're talking about for a company where you're an employee, there is no place on the federal return for you to take a deduction for it. Only when you're self-employed. But on Pennsylvania, there is an employee business expense where you can take deductions for that, for a W-2 employee. So the first question makes a difference of, are you self-employed or are you a W-2 employee of the company? And then that puts you down the track that you can go.
Yeah, for me, I'm one of those weird people on both. So
yeah, yeah. But you're still going to deduct your mileage at different places. And so the mileage for the W-2 job is not deductible in the federal return, but the mileage for your self-employed job is. And so you have to make that distinction. Yeah. Okay. All right.
thank you.
Sure, you're welcome. Thank you. Equipment. So another hard one for people to think of are equipment pieces that they purchase. IRS says anything that has a useful life of more than 1 year is going to go into the depreciation system to be deducted on your tax return. Okay, so something that has a useful life of more than 1 year. IRS does not give a dollar amount, which to me makes much more logical sense. So several years ago, took on a client from the previous CPA. I'm looking at their depreciated assets. There's a $39 telephone that's being depreciated as office equipment over 7 years. Technically, it's correct because you would expect that phone to last more than 1 year, right? So you should depreciate it 7 years for office equipment and depreciate over 7 years. So IRS came to the rescue a couple years ago, and they did give us a method that if we create a financial statement policy in our business for where we will write off, then we can just write those things off as supplies. IRS actually gives a cap of $2,500. Now, again, you have to have a written financial policy and set a dollar amount. For most of my clients, I do not recommend that they set it as high as $2,500. I usually recommend they set it at $250 or maybe $500. Then any pieces of equipment, office supply things, et cetera, that they buy that is under that amount, they just write them off, and then the ones over that they depreciate. So you do have to calculate that. And if you have no system, then you have no dollar amount. So if you don't have a written financial policy, you have no dollar amount that goes into the depreciation system. Now, IRS allows you on your federal return to do what's called bonus depreciation, which allows you to write 100% of everything that you bought that year that is in the same class life. So all 5-year items, all 7-year items, all 10-year items, write them off all in that year. But it isn't all or nothing. So you have to take everything that you bought that was 5 years. So computers are all 5 years. So you'd have to write all of those 5-year items off in this year. But what if you didn't want to do that? What if that was too much of a write-off and you wanted to save some of it over? You can't do that with bonus depreciation. But there's another system called a Section 179 deduction that allows you to pick and choose which items particularly you want to write off, and whether you want to write the full amount off or you just want to write part of it off for this year and let the rest of it depreciate. Now, I'm going to tell you all of these decisions that you make here about depreciation is a decision that you do with me at tax time. You do with your tax professional at tax time for how you're going to handle it. And I really will start off looking at with taking the least amount of depreciation and letting things push forward, and then have a discussion of, as your business is growing, is the deduction worth more to you in this year when your income is low, or will it be worth more to you next year as your income is increasing? So that would be a question that we would need to see for individual situations. So as you're thinking about pieces of equipment, sometimes that's people's only strategy for tax planning at this time of the year is they're like, oh, I'm going to go buy some equipment. But what I want to point out to you, it is not considered a deductible item until it is placed in service. So it is ready to use. So if you order a piece of equipment here today on December 14th, but you're not going to take delivery till January, I don't care if you pay for it today. If you don't take delivery until January and put it in your business to use, it's a January deduction, not a December deduction. So if you're going to go out and buy that new vehicle for the business, you need to take delivery before the end of the year. So make sure in service, you have to have it in service, placed in service in the year to be deducted in that year. So understanding those. So all these pieces of equipment are going to need to be depreciated in some way, written off in some way. And the timing of that is one that you can play with on your tax return. You do want to understand that your bonus depreciation and your Section 179 write-off, Pennsylvania does not recognize bonus depreciation on the Pennsylvania return at all. And the Section 179 write-off is capped at $25,000 for the year. So if you buy an $80,000 piece of equipment, you can write the whole thing off on the federal return, but Pennsylvania is only going to allow you to take $25,000 off, and the remaining amount you have to depreciate out over the 5 years, 7 years, whatever the piece of equipment is. That is true for Maryland and West Virginia here. Many states did not conform with the bonus depreciation or the increase in the 179 write-off that the federal government has been doing over the past few years. So there'll be a difference on your state. So understand there's a difference on your state. Okay. All right. The other item is inventory, is also usually something hard for people to wrap their head around. And sorry, real quick here, is there any pros on bonus depreciation then? If you really have a big federal return that it's hitting, there may be a good reason to go ahead and do it on federal. You just won't get the advantage on the state. The state, you're still going to depreciate it out. So you'll still get to write that $80,000 piece of equipment off over an amount of time on the state return. And so really looking at a client's particular situation, sometimes I do bonus depreciation, sometimes I do not. So we look at their goals that they're trying to reach. Okay. Inventory. So you need to keep a physical inventory, do a physical inventory count at the end of every year. If you carry an inventory on your tax return, they need to know the beginning of the year inventory. So that would be last year's ending number, how much you purchased at your cost, not what you're going to sell for at retail, but how much you purchased, the dollar amount you spent on the purchase of what you have, and then what is your ending inventory. So if I take your beginning inventory plus everything you purchased for the year minus your ending inventory, I now have what is called cost of goods sold. And when I get this cost of goods sold number, it will account for everything that has happened. So that's given me the cost of everything that you actually sold during the year, any merchandise that you had to dispose of because it went bad or was damaged in some way, any merchandise that might have been shoplifted out of your business. You don't need to track those numbers separately. That inventory number will take that into account, because at the end of the year, when you do that physical count, anything that was gone in some way, such as being stolen or damaged or has gone bad, won't be there to count. So you don't still have it to sell. So that cost of goods calculation will get you that number for that. And so if you still have inventory on your shelves that you paid for this year, you're not getting as a deduction on this year's tax return. It's carrying over until the year that it's sold. So that is why you see a lot of people try to do an inventory reduction at the end of the year. They're trying to get some fast cash into the business and want to get that stuff off their shelves, off their books, to be able to take that inventory deduction right then. I still wouldn't sell for more than a price that I'm willing to take for it. I mean, there's no reason just to get rid of it, because it's not costing you anything on your federal taxes, on your tax return. It's just not being a deduction for you yet. It'll be a deduction next year when you sell the merchandise. So still good sale price, always a good reason to have a good sale. People will buy things when they're thinking they're getting a bargain, but don't sell for less than what you paid for it. And remember, your inventory count is always at your cost, not your retail amount, not what you're selling it for. Another problem I see for businesses starting out that they need to really be staying aware of is whether people are an employee or a subcontractor to them. So this is one that has a lot of focus on. You would put an employee on payroll, and your subcontractors, you're going to issue a 1099 NEC. So starting in 2020 as a 1099 NEC, it used to be a 1099 miscellaneous. But now they took the box 7 off of the 1099 miscellaneous. It has its own form now, a 1099 non-employee compensation. Okay. So a lot of people, I will hear them as they're starting business of, should I have them be an employee or should I have them be a subcontractor? Well, it depends on what you're going to do. An employee, you have control of how the work is done. So if you're going to direct how the work is done in detail, that you're controlling that, usually you would have them at your location using your equipment, or if you're going to provide equipment to them, that's an employee. You're maintaining control. But a subcontractor, your control is the finished product. I will pay you X because you delivered this product to these specs to me at the end of the time. They're using their own equipment. They have the opportunity for to make a profit or a loss on it. You're not telling them how to do it. You're telling them what end product you need to get out of it. That's a subcontractor, and you're going to pay them, issue them a 1099 NEC at the end of the year. There's no such thing as a 1099 employee. I hear people say that all the time. There is no such thing. They're either an employee or they're a 1099 subcontractor. Okay. Now, your subcontractors, the biggest mistake I see happen here in another couple of weeks, we're going to start doing W-2s and 1099 for business owners, and I will have more than one business owner that gives me information for some subcontractors that they paid, and they never got their Social Security number and other information they need to do the 1099. I'm going to tell you, it's the employer, it's the business owner that's going to be in trouble, because first off, IRS says before you pay them, you need that W-9 completed or have the equivalent information. The W-9 form simply gets the name, address, and Social Security number or EIN number if they're a business for that person that you're hiring as a subcontractor. And if you do not have that information, when you write their check, you have to do 24% backup withholding. Okay, so I don't write a check until I get the 1099, I'm sorry, the W-9 completed first. We just did headshots this morning with a photographer. I had the check ready to pay the photographer, but first I laid in front of her a W-9. Fill this out for me, please. And thank you, now here's your check. Okay, I don't pay a subcontractor until I have that information. Okay, keep yourself from getting in trouble. And technically, if you don't have the information, you need to do 24% backup withholding. Okay, so doing those. Difference between employees and subcontractors. So that it's not what you want it to be, it's what's the facts and circumstances of the situation. Do you have control? All right. Couple other expenses I wanted to talk about is unreimbursed partnership expenses and an accountable plan. So if you are in a partnership or you have a corporation, they can't do an office and home because the corporation or the partnership doesn't have a home. So they are in the home of the partner or the home of a shareholder, but they themselves do not have a home. So there is not a deduction for that on the tax return under a partnership or a corporation. So to get around that, we have a couple ways we can do it. So you can get the same deduction, but under a partnership, in your partnership agreement, you're going to have listed in the partnership agreement that the partnership will not reimburse the partners for an office and home expense. So that then allows the partner to calculate that expense themselves using the same method as you would for the office and home on the Schedule C, and take that deduction right on the Schedule E form where you put your income from your partnership. The line below it is unreimbursed partnership expenses. The other type of expense that I see partnerships often do is they are not going to reimburse the partners for their mileage expense. They allow them to deduct it themselves right on their own personal tax return. For a corporation, we do the same thing as an accountable plan. Under a corporation, you're an employee of the corporation. And just like a corporation, anytime that it asks an employee to do something or to pick something up while you're out, they're going to reimburse them for what they spent. You can set up an accountable plan where the corporation reimburses the owner of the corporation for an office and home or use of their vehicle, et cetera, something like that. So you can still take the same deductions on that partnership and the corporation. It just has to get done with a little extra paperwork. Okay, so it comes around for that. All right. Changes for 2021. So part of our big changes that happened in 2021, I already mentioned the meals thing of getting 100%. If you have employees, there is an employee retention credit. There's actually one in 2020. There's one in 2021. So if you look at your first quarter of 2021 and compare it to the first quarter of 2019, if your revenue, so top line revenue, is down 20% or more, you can take a credit for what you pay to employees. It is worth $7,000 per employee because it's 70% of the first $10,000 that you pay an employee in the quarter. So that's where it maxes you off at. Okay. For the employee retention credit, it is available for the first, second, and third quarters of 2021. It has been repealed for the last quarter of 2021. If you think you would have qualified for this credit in 2020, you can still go back and amend your returns for 2020. In 2020, though, it had to be a 50% reduction of revenue by the quarters. Also, you can get the employee retention credit 21 or 20 if your business was shut down due to COVID or had a reduction of hours or capacity. So if you were affected by COVID, such as a restaurant, that for so much of last year, I don't think at any time during 2020 were they able to be at 100% capacity once the pandemic started. And many of them still into the first quarter of 21 still had a reduced capacity. So they could also apply for the retention credit. So it was either full or partial shutdown or your revenue was decreased, okay? Revenue decreasing for 21 has been the biggest one that I've seen with my clients. They also started a new one. So if you're a new business, meaning you started since February of 2020, so since the pandemic has started, okay, you can get this employer retention credit here in 2021. There is no reduction of revenue. You just need to be a new business. You don't have to have any shutdown. You don't have to have any reduction of revenue. Just if you're a new business who started out since February of 2020 and you have employees who are not related to you, employees who are not related to you, you can get that $7,000 credit per quarter for all 4 quarters of the year. So this one was not repealed for the 4th quarter. This one can continue for 4 quarters of the year. I have seen some tremendous credits from business clients on this from 20 and 21. I think our largest one, we amended their 20 payroll reports, and it was $126,000 credit. Okay, so these can be some good numbers. So if you have employees, this is something you should investigate to see, do you meet any of the qualifications? All right. Also changes that we see here in our 21 and 20, we saw them also. We saw a lot of different state and local grants coming out that would be beneficial, that would help a business with continuing in business. All kinds of different programs. Sometimes they were at city level, sometimes they were at county level, sometimes they were at state levels. They were out there. Most of those are taxable on the federal return, but the ones from inside the state of Pennsylvania are not taxable on the Pennsylvania return. So looking at those things. Also what we had in 20 and 21 was our payroll protection program. So a lot of people got the PPP loan. It was not taxable on your federal or state, and it was deductible as expenses for both the federal and the state. So knowing that there can be a difference between your federal and state, but getting all of those programs out there that might be of benefit to you. They have really slowed down, but there really still are different grants. We're seeing things that target certain areas. Food programs and restaurants and farmers have gotten a lot of these too. So just knowing that there's a lot of those grants still out there, and be checking at your local levels to see what you may qualify for. Since all taxes end up happening down on the personal side, I did want to point out some changes for 21 that are on the personal side here. You had a 3rd stimulus in 21. You'll have to show it on your tax return, just like last year. You never have to pay it back, but you might get a credit. The advanced child tax credit, any of you that got that from July to December, that's only a 21 credit, but you're going to have to balance that on your tax return this year. And you may have to pay some of that back, because if your income increased, you don't qualify for it, and then you might have to pay it back. Even if you don't have to pay it back, it will reduce your refund for this year, because it's an advance of the credit that you would be getting on the tax return. And so you got that throughout the year, and then you're getting the difference as your refund. Child care for 2021, our child care expenses that we could take as a deduction have been for many, many years. $3,000 for one child, $6,000 for 2 or more children, and your credit was maxed at 35% for 2021. $8,000 of child care expense for one child, $16,000 for 2 or more children, and the credit could be 50%. And then just one more thing I wanted to point out to you is maximizing any contributions you might have. If you have a health savings account or a flex account, if you want to put money into a state 529 plan for education for kids for down the road, make sure you get those in before the end of the year. Also your charitable donations. And I mentioned this just a little bit before. The current tax rates that we have right now, they will expire at the end of 25. And so 2026, everybody's tax bracket's going up. Okay, so think about now, do I need income now sooner? Do I want to be paying on money now, or do I want to be pushing it off? Do I want to push an expense off? So if I'm going to be purchasing equipment in the business, can it wait a couple of years till it's a bigger bang for my buck? Can I pull more income into my bracket now? Do I want to, instead of putting money into a deferred retirement plan, do I want to put it into a Roth account? So I'm paying tax on the money now. So thinking about those type of things. Can you push income to other family members, such as hiring your kids in the business, hiring your spouse in the business, hiring your parents in the business, somebody that's in a lower income bracket? If you're paying them, that's a deduction for you on your business return, and they'll pay taxes on it at a lower rate. So getting to know those. All right, those are the topics that I wanted to get for you. I should have left just a little bit more time for questions. We'll take a chance at questions here. I do want to show, we put into the chat here for you. We have a business owner's tax checklist. If you would like to get a copy of that, if you would just click that link and fill out that information. And also, we always offer, anytime I do a presentation, we offer to the participants a 30-minute discovery call with me. So if you'd like to discuss a couple of these ideas that we talk about, or maybe a situation that you have, I'd be glad to have a 30-minute conversation with you. see if I can help you out on any of that type of thing. Be glad to do that. And I do most of my meetings over Zoom like this. We are open for business in our office, but I'm down here in Hagerstown, so a Zoom meeting might be an easier one to answer questions for you. Be glad to do that. So if you have any questions right now, be glad to go ahead and field those.
Leighton, can folks unmute if they just want to ask a question?
That'd be great.
I'm not sure if.
I'm not sure. I think someone did because Joe chimed in earlier.
Okay.
Yeah, Joe was able to.
So if you can unmute, feel free to ask questions, or you can type it in the chat. And
Ellen knows if there's one person who can figure out how to talk on Zoom, it's me.
There you go, Joe. We appreciate that.
I have a question.
Yes.
You were talking about the subcontractors. So what if you hire somebody to like do photography or they do like video equipment and you got to give them like $1,300 for their services? Is that considered subcontractor that before I pay them, I have to get a the W-9 from them?
Yes. Yes. And that's exactly my scenario this morning. We were having headshots done. There's a photographer that came in to do headshots for the office. And so got my W-9. Yep.
So I have a question. I do books for a nonprofit and they paid out different people to come and help with this event. They have to give I-9s to all those people before they pay them. And then they have to issue 1099s.
If it's over $600, you have to issue the 1099 at the end of the year. The only people you would not issue a 1099 to is a corporation. But until you have them fill out the W-9 that tells you what they are, you don't know they're a corporation in a lot of cases. Sometimes you do, depending on who it is.
So is it,
Yeah.
I guess I have to go back now to all those people we paid a few weeks ago and get them to fill that out and then get them a 1099.
Yes, and they won't be surprised by it. I was the treasurer for my office for my church for many years, and any speakers that came in, I would have the check ready for them, but I would hand them a W-9 first, saying, I need you to fill this out for me, and then I would give them their pay for having spoke at the church that day, their speaking fee. So yeah, anybody that provides services for you, unless they're a corporation.
Okay,
So
thank
this
you
is
so much.
great information to have. And unfortunately, we've gone past time. For everybody on the call, I know you have Bev's information, contact information. So don't be shy. You're also very welcome to reach out to me, and I will connect you with Bev and Steve at Saunders Tax and Accounting. And I just want to say, Bev, thank you very much for being willing to come on and do this for the LaunchBox. It's very, very valuable information for all of us. Thank you very much. And Leighton, thank you for hosting.
Absolutely. Thanks, Bev. Thanks, Helen. Thank you, everyone, for coming. Stay tuned to your email. It'll probably be before the end of the week. I'll send out the recording and the slides if anyone needs to reference them. And yep, like Helen mentioned, we'll have another Lunch and Learn at the Chambersburg Chamber next month, February 1st.
Bye, everyone.
Bye-bye.
Merry Christmas.
Merry Christmas.
Christmas, yes.